Hello traders, and welcome back to Explain the Charts. Today is October 1st, 2025, and we're diving deep into the Australian dollar versus the US dollar, or AUDUSD, which is sitting at a fascinating and critical juncture. First, we'll cover the whirlwind of news events creating this volatility, and then we'll break down what the charts are telling us. Let's get right into the fundamental picture. The market is currently grappling with several conflicting narratives. On one hand, the US dollar is facing significant pressure due to the ongoing US federal government shutdown, creating uncertainty for the American economy. Adding to this pressure, the latest ADP National Employment Report was a shocker, revealing the private sector shed 32,000 jobs in September, a stark contrast to the expected gain of 45,000. This is the largest decline in over 2 years and points to a rapidly weakening U.S. labor market, which is typically bearish for the U.S. dollar. However, there's also political intrigue at the U.S. Federal Reserve, with attempts to remove a board member, which some traders believe could lead to higher interest rates if unsuccessful. Meanwhile, for the Australian dollar, the picture is also mixed. The Reserve Bank of Australia recently maintained a hawkish stance, warning of upside inflation risks and dropping hints about potential easing, which has been supportive of the Aussie. Australia's economy has shown resilience, but a soft jobs market and its close ties to China's mixed economic data remain key concerns for investors. Interestingly, despite the fundamental reasons for Aussie's strength, recent data from the CFTC showed that large speculators increased their net short positions, suggesting many are still betting against the currency. This creates a classic tug-of-war between fundamental drivers and market sentiment. Now, let's see how this all translates to the price action on our daily chart. As you can see, AUDUSD has been in a powerful uptrend for most of 2025, recovering from lows near the 0.60 mark back in April. The price has been making a series of higher highs and higher lows, a classic sign of a bull market. Just yesterday, on September 30th, we saw the pair spike to a new yearly high of 0.69417. This level is extremely significant as it aligns with the high from late September of last year, making it a major area of resistance. The market tested this key resistance and has since pulled back, as we can see from today's red candle. This pullback could either be a healthy consolidation before the next leg up, or the beginning of a more substantial reversal. The primary upside target for bulls was this 0.6942 level, and breaking decisively above it would open the door to the psychological 0.7000 level. On the downside, we have several layers of potential support to watch. Let's zoom in on the price action since August to get a clearer picture. We can see the uptrend accelerated significantly throughout September, which corresponds with the growing concerns around the U.S. economy and the RBA's hawkish tone. The year-to-date ceiling mentioned in market reports at 0.6707 hit around September 17th, acted as a temporary resistance before the final push higher. Notice the strong bullish candles on September 24th, 26th, and 29th, showing aggressive buying pressure. However, the candle on September 25th was a sharp rejection, and today's candle is also showing selling pressure from the highs. This indicates a battle is being fought at these elevated levels. Immediate support can now be found at the low of today's candle, around 0.6850. A break below that could see a test of the September 25th low around 0.6812. The next major support zone aligns with the news reports, sitting around the 0.6700 level, which was that previous peak in mid-September. Further down, the key weekly low mentioned at 0.6520 from September 26th would be the line in the sand for this uptrend. Now let's switch to the 15-minute chart to examine the most recent price action we have data for, which is from the end of the trading day on September 30th. Here we can see the microstructure of the price action as it approached that major high. Throughout the day, the price was in a clear uptrend, grinding higher. We can observe a period of consolidation in the 0.6610 to 0.6615 range during the last few hours. This tight range shows indecision right at the end of the session, following a strong bullish day. Volume appears to be tapering off into the close, which is typical. This short-term view highlights the exhaustion of buyers as they approach the key daily resistance level we identified earlier. The failure to push higher and the subsequent drop on October 1st shown on the daily chart makes perfect sense when viewing this intraday price action. For short-term traders, a break below the support of this consolidation range, around 0.6607, would have been an early warning sign of a potential reversal. Conversely, a strong break above 0.6620 would signal a continuation of the intraday trend. Coming back to our daily chart for the bigger picture, let's recap the critical levels and look ahead. The main resistance to watch is the recent high at 0.6942. A convincing break and close above this level is needed for the bullish trend to continue towards 0.7000. Key support levels are, in descending order, 0.6850, 0.6812, the major psychological and technical level at 0.6700, and finally the major trend support at 0.6520. So, what's our unbiased prediction? The fundamental backdrop is messy, but the recent weak U.S. jobs data is a powerful catalyst that should continue to weigh on the U.S. dollar. Therefore, the path of least resistance appears to be higher for AUDUSD in the short term. I would place a 60% probability on another attempt to break the 0.6942 resistance within the next week. This likelihood would increase if we see further negative U.S. data or if headlines suggest the government shutdown will be prolonged. However, there is a 40% probability of a deeper correction first, especially given the bearish sentiment shown in the CFTC data and the strong rejection from the yearly highs. A break below 0.6812 would strengthen this bearish scenario, putting a test of 0.6700 firmly in play. Things to watch for will be any news regarding the U.S. shutdown, upcoming inflation data from both Australia and the U.S., and any statements from RBA or Fed officials. Also, keep an eye on commodity prices, especially iron ore, as they are a key driver for the Australian dollar. The chart is telling us we are at a pivotal moment, so prudent risk management is essential. Always wait for confirmation before entering a trade, whether it's a break of resistance or a breakdown of support. That wraps up our analysis of AUDUSD for today. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. The Forex market is highly volatile and carries significant risk. Always conduct your own thorough research and analysis before making any investment decisions. Thanks for watching Explain the Charts, and we'll see you in the next video.